Gambling on stocks while ignoring debt? It drives me crazy! Your 20 interest rate is laughing at you right now. Stop filling a bucket with holes. It's time to fix this. I'll show you the exact sequence for wealth. Don't skip the foundation. Follow the plan or lose it all. Here is a fact that might just shock you. 1 in 3 Americans doesn't even have an emergency fund. That is a financial disaster waiting to happen. The median amount saved for emergencies is a measly $500. $500! That's less than a single car payment for most people. Meanwhile, these same people are asking me if they should buy individual stocks or crypto. It's like buying a Ferrari when you can't fix your broken car. The truth is, there's an optimal order for investing, a sequence that can save you tens of thousands of dollars and speed up your journey to freedom. Most people skip the boring work because it's not thrilling. But getting this wrong is devastating. It's like building a house on a cracked foundation. Every month you delay paying off credit card debt at 22%, it grows faster than any reasonable investment you could ever make. Step 1, before you invest a single dollar anywhere else, is to establish an emergency fund. I know, it sounds boring, but it matters more than you think. An emergency fund creates a psychological safety net. It's the buffer that stops you from making terrible decisions when life throws you a curveball. When your car breaks down or you get a surprise medical bill, having that fund means you don't have to sell your investments at the worst possible time. Start by saving your first $1,000 as fast as you can. This covers minor emergencies and gives you that vital initial psychological win. Then, work your way toward 1 full month of living expenses. Once you hit that, keep building until you reach 3 months to secure your base. Step 2, eliminate all high-interest debt. When I say high interest, I mean anything charging you more than about 8% a year. Kill it now! Credit card debt is financial cancer. Carrying it while investing is like trying to run a marathon with a heavy backpack full of rocks. You will lose. Paying off a 22% credit card is like earning a guaranteed 22% on your money. That's better than Warren Buffett's average. Use the debt avalanche. Pay the minimum on everything, then throw every extra dollar at the debt with the highest interest rate. It's the fastest way. Woo! Now, step 3 is the exception. Contribute enough to your employer's plan to get the full match. It's a guaranteed 50 or 100% return. It's like your employer is leaving free money on the ground. All you have to do is pick it up. No other investment can guarantee that kind of growth. Contribute just enough to get the full match. Then, redirect all extra money back to destroying that debt. Once it's gone, we move to step 4. Step 4, max out your IRA. This comes before more 41A money because your IRA gives you far more control and typically has much lower fees. Corporate plans often offer expensive mutual funds. Those fees eat your returns like termites. With an IRA, you keep more of your money working for you. Choice time, Traditional or Roth? Do you want to pay taxes now or later? If you're early in your career and earn less now, go Roth for tax-free growth. Step 5 is the HSA. It's the Swiss Army knife of retirement. It has a triple tax advantage that is unmatched by any other account in America. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical bills are tax-free. It's the holy grail of tax planning. Don't ignore it. Step 6. Go back and max out your 401k. The limit for 2025 is $23,500. This is where you build serious wealth. Only after all that do we reach Step 7, the taxable account. This is the Wild West. Flexibility is high, but watch out for the tax drag. Taxable accounts mean the IRS wants a cut of every dividend. It's like running with sand in your shoes. Use it for goals like a house or early retirement. So, what should you actually buy? Don't try to be a stock-picking genius. Use low-cost, broad market index funds or ETFs like the S&P 50, 500. So, what should you actually buy? Don't try to be a stock-picking genius. Use low-cost, broad market index funds or ETFs like the S&P 500. The data is clear. Most pro managers fail to beat the S&P 500. Why play a game that the pros consistently lose? Keep it simple and keep your money. Finally, avoid the lifestyle inflation trap. You get a raise and suddenly you need a bigger car. That is the silent killer of wealth and freedom. When you earn more, invest the difference before you see it. Automatize your future. Pay yourself first and your future self will thank you. Let's talk about asset allocation. This is how you split your money between stocks, bonds, and cash. Get this wrong and you'll panic sell at the bottom. A classic starting rule: subtract your age from 110. That's the percentage you put in stocks. The rest goes in bonds. Simple, powerful. At 25 years old, you should have 85% in stocks. At 50, about 60%. Risk tolerance drops as retirement gets closer. But here's what no one tells you. You need to rebalance every single year. Markets shift. Your portfolio drifts. Discipline keeps your strategy on track. Now let's talk about the biggest wealth destroyer of all, emotional investing. The market drops 10% and people start panic selling everything. Between 2011 and 2020, the S&P 500 returned about 6% per year, but the average investor earned less than 3%. Why? Emotions. The solution is automation. Set up automatic monthly contributions. Remove yourself from the equation. You can't panic sell what you never touch. Dollar cost averaging is your secret weapon. Invest the same amount every month, no matter what the market does. Buy more when prices are low automatically. Market crashes are not disasters for long-term investors. They are sales. When stocks drop 20%, you're buying at a 20% discount. Celebrate! So, what should you actually buy? Don't try to be a stock-picking genius. Use low-cost, broad market index funds or ETFs like the S&P 500. Real estate offers leverage and tangibility. You can buy a $300,000 property with $60,000 down. That's 5-to-1 leverage. But real estate is not passive. Toilets break, tenants leave, roofs need replacing. It's a business. Make sure you're ready for that commitment before diving in. If you want real estate exposure without the headaches, look at REITs. Real estate investment trusts trade like stocks, but pay out most of their income as dividends. Now, a word on crypto. Bitcoin and Ethereum exist. They might be part of the future, but they are volatile. Never invest more than you can afford to lose entirely. If you want crypto exposure, cap it at 5% of your total portfolio. That's enough to benefit if it moons, but not enough to destroy you if it crashes. Let's talk taxes. Every dollar you lose to unnecessary taxes is a dollar that stops compounding forever. Tax efficiency is not optional. It's essential. Hold your investments for over 1 year before selling. Short-term gains are taxed like income. Long-term gains are taxed at 0, 15, or 20%. Big difference. Tax loss harvesting is another powerful tool. If an investment loses value, sell it to capture that loss on paper. Use it to offset gains elsewhere in your portfolio. Let's zoom out and look at the full picture. Your net worth is simple: assets minus liabilities. Every decision you make either grows or shrinks that gap. Track your net worth every single month. What gets measured gets managed. You cannot optimize something you refuse to look at. Face your numbers. Here is your complete 7-step roadmap: emergency fund, kill debt, employer match, max IRA, HSE, max 401k, then taxable, in that order, every single time. This isn't about being perfect. It's about being consistent. Start where you are. Use what you have. Do what you can. The best time to start was yesterday. Most people overcomplicate this. They read 50 books, watch 100 videos, and still never invest a single dollar. Analysis paralysis is the enemy. The person who invests $500 a month for 30 years beats the genius who invests perfectly for 10 years. Time in the market wins, always. What is your next step? Tell me in the comments. Is it the emergency fund or the 401k EGA match? Declare it now to stay accountable to your goals. If this video brought clarity to your plan, hit that subscribe button. We're building a community of smart investors here.